So, are banks evil? Are mortgages traps? Are you a victim for becoming a prospective homeowner? One prominent YouTuber seems to think so. We're going to give our commentary on it in this video. This is JP from Blueprint for Prosperity. We're going to dive right in. So the video I'm covering or giving a response, commentary to is going to be created by Clear Value Tax. I've done other commentary videos on his content before. I like his channel. I like his content. And he has a very large following. So I think it's kind of prevalent to pick out some things from time to time that I agree or disagree with and give another financial professional's personal perspective on some of the content he covers because he reaches such a broad audience. And one day I strive to have these videos reach a broad audience as well to bring value to you guys and education to you guys. So in the video that he put out originally at the time of this recording today, he was speaking on the fact that mortgage rates are significantly higher than they've been and how ultimately, in his opinion, mortgages are financial traps that you'll end up paying more to the bank than on the actual property itself. He uses a mortgage calculator and a mortgage amortization calculator to break down these numbers, which many of us have seen it. If you're anywhere near this financial space or any kind of financial education, you're probably privy to the fact that when you get a mortgage, if you live in that home through the duration of that loan, 30 years on average, you will pay more in interest than you've paid for the home. And interest is also front loaded on the mortgage payment, meaning that the first 7 to 10 years is almost exclusively going to interest with very minimal amounts going to the mortgage principal and paying down. So that's something that most of us know. And if you don't know, you know now. So his point was that higher interest rates are a trap by the banks on mortgages to, trap people in their loans and debt and to rack up all this money and to get rich off of them on their mortgage. He went into more depth than that, but ultimately it was about, as homeowners, most of us being, almost victims of sort to mortgage loans and lenders, who are preying on us with higher interest rates. So my commentary on this for you, the value in this is, number one, banks don't determine interest rates. They don't. It's not up to the bank. It's not up to JP Morgan Chase, Bank of America, Wells Fargo, Citi. It's not up to that institution to set higher mortgage rates. That's not how it works. There are much larger factors at play determining mortgage interest rates outside of banks. That's number one. Number two, banks do not totally benefit from higher interest rates because yes, your mortgage is 6 and 7% on average in the last 7 months or so, but your deposit accounts are also 3, 4, and 5% as well. So yes, there's a delta in the spread because banks are for-profit entities. So of course there's a spread. At the end of the day, it's not like you're getting, less than 1% and paying 6 or 7% on a mortgage, but less than 1% on your deposit account, unless you're in the wrong deposit account. Do your homework. Banks, most banks, even the bigger commercial banks that don't have the most attractive rates are paying somewhere within 2 to 3 interest rate points of a mortgage on their deposit accounts, CDs or high yield savings. The next major factor is probably the most important. I am a big advocate that there should not be as much evil this and evil that narratives in finance. It's too emotional. And the concept of creating boogeymen is paralyzing for most individuals. I'm gonna leave the link to the video in the description below. I want you to take the 13 or so minutes of that video to watch it after you cover this one, because I want you to pay attention to the ominous tone that he uses throughout the video about banks and lenders. There's not really good and bad guys. There's just leverage. There's just positioning, meaning banks and financial institutions, the wealthy, so on, definitely have the ball in their court a lot of times when you're doing business with them. They write the rules in most cases or have huge influences on the rules and how the financial game goes. That having been said, banks and lenders are your business partners. They are not the devil. And I'm going to explain to you why that's the case. Number one, in order for that lender to that lender or that bank to be able to extend you a mortgage, you need to be financially healthy to some degree. You need to have strong financials, or at least reasonably decent financials, to get into that mortgage in the first place. What that basically means is that the bank has an incentive to provide you value on the deposit side, financial tools and products that allow you to be in position to be low risk enough to lend that mortgage to you. And if you think about the structure of banking, that is the name of the game. They need healthy borrowers in order to make money. If they make these loans out to a bunch of people who can't afford it, whose finances are in shambles, poor deposits, poor credit, no assets, no cash flow, no income, no collateral, we went through that in 2008. It's a disaster. And the banks don't make money. They go under. So this concept that banks are these malicious, vicious, savage boogeymen is a little ridiculous. I have to be honest. And again, this is not a shot at him. I think his channel is great. He puts out good quality content and he works really hard. He's putting out videos every day. But that having been said, it doesn't mean everything we say is correct. And I'm going to say things that may be worth challenging in my videos from time to time. But I think that it's absolutely wrong to paralyze you as an audience at the concept that somehow banks and financial institutions are the devil. You just have to learn how to play the game. Financial education is the issue. It's not about good guys and bad guys, cops and robbers. That's not what it's about. It's about financial education. Banks know how to play the game. You should learn. If that's the case, we wouldn't have first generation wealth. Everybody's wealth will be passed down. There's 80+% of millionaires in the United States are being made in first generation. First time millionaires. That means people are figuring out how to play the game. So your job, he describes in the video how banks are making so much money on interest while you're paying next to nothing in principal for a long time on your mortgage. He encourages you to pay down your mortgage sooner if you have the capital. This is what I'm going to say to that. This is a major part of the value in this video, so I hope most of y'all are still tuned in. You get your value from structuring that relationship with the bank efficiently. The problem is most of you go out and get loans completely benign and unintentional, meaning that you go out for that product or whatever that is you're going to borrow for, and that's it. You go out at the last minute, very little pre-planning, get a mortgage just because you want a house for whatever reasons, or get a car for whatever reasons. There's no structure or strategy financially, no intentionality behind what you're trying to accomplish. This entire channel is about building your net worth and becoming intentional with your financial decisions, because that is the name of the game. You getting a mortgage, if you strategically position yourself, is an asset for you, even if it costs you hundreds of thousands of dollars over 30 years. Mind you, most people don't stay in their homes more than about 8 years anyway. So that's mostly out of the window for the majority of people. People don't stay in their homes for 30 years, especially not their first home. So anyway, that having been said, your mortgage is an asset if you use it in that way. I'm gonna tell you a few scenarios within banking how it's an asset. The number one example is that mortgage is the supreme installment loan to have on your credit report. It's literally the supreme installment loan to have on your credit report, meaning that having it and paying on time on it, the longer you have it, will look pristine on your credit report and allow you better access to more affordable capital to take and invest and grow businesses. Having a mortgage in itself, along with whatever positive trade lines you have on your credit report, is going to empower you, literally on paper, in underwriting, to get access to more funding at better rates and terms, just having a mortgage. I shot a video a few weeks back about my own FICO score, because as great as my credit is, I personally have FICO scores ranging from 760 to 810. Across all FICO models, the lowest is a 760 and it ranges up to an 810. I have very strong personal credit. And that being the case, I still, the index that FICO uses to gauge your resilience, it's a resilience index, the resiliency against financial hardship or economic turbulence, indicated that one of the weak spots, one of the only weak spots I have, is not enough installment loan history. I am a financial professional, a banker. I've had auto loans. I have personal loans. I still don't have enough installment history on my credit report by FICO's own admission. Why is that? Because I don't have multiple mortgages on my personal credit. So my point in bringing that live example to you is that you having a mortgage, number one, empowers your credit report as long as you're paying on time on that mortgage. It's going to open the door for you to get access to quality, cheap, and affordable capital with great rates and great terms that you can then go out and invest in businesses and invest in assets. So if you get a mortgage for $400,000 and you end up paying $500,000 in interest plus the principal over the life of that loan, if you hypothetically stayed for 30 years, sure, that's actually a price of doing business when that same mortgage, number one, could have empowered you to borrow capital to, at that same 30-year window, invest in businesses and invest in the right assets and likely make a lot more than $500,000 over the course of 30 years. Number two, your home is often able to be collateralized. If you have the right banking relationships, your home, your good credit and proper banking relationships, your home, once it has a reasonable amount of equity, can always be collateralized for you to access some of the value in that home to, again, go out and invest in assets and invest in businesses. Your home is a part of your positive net worth if you structure it that way. So you having an expensive mortgage with a high interest rate, you staying there for 30 years and paying 110, 120, 130% of the actual cost of the home in interest is a price of doing business. And if you're smart, that home will hopefully also have kicked the door down on the back end for you to make millions of dollars over that 30-year period if you just structure it to do so. The equity, the reporting on your credit report, all of these different things empower you. When you're going to apply for credit cards, if you put down that you own your home, they don't even ask you your mortgage payment. They'll see it on your credit report, of course. But at the end of the day, it's looked at as a more positive thing than being a renter, is the moral of my story. When you put it down to apply for credit cards, the list goes on of examples of how your home is actually an asset if you strategically allow it to be. And even if you're paying exorbitant interest over the course of time, that is not an excuse to stay a renter. It's not. There's non-monetary benefits you can't put a price on home ownership as well. Statistics continue to show people are healthier, kids come out better. The list goes on. Relationships. There's literal statistics that are non-monetary, non-economic information that shows that it's overall healthier and more prosperous and more benefit for people psychologically as individuals and as families through home ownership than renting. You need to keep this in mind when you're watching this kind of content. My point is to empower you to understand, get rid of the boogeymen, stop the narratives when it comes to your money and your finances. Empower yourself, find the strategy. Banks need profitable, successful, prosperous people to do business with. They don't make all their money from poor people. That's not how this works. Some of banks' most profitable customers are their wealthy customers. Yes, they make a ton of money off of us. You should do the same. If I have strong personal credit and great income and great assets, and I can get a bank to lend me dirt cheap money, it is my job to go out and get access to that capital and put it to work. If my mortgage is costing me 6%, go find an asset that pays 8 to 10. It's not hard. And your home ownership is going to help you do that. What benefit comes from renting? What financial benefit do you get from renting? When you compare it, when you start talking about leverage, collateral, you have flexibility. That's great. But you can't, in most cases, you don't have much control of that asset. Barring negotiations with that landlord, you don't have control of that asset. You're borrowing it from day to day. There's value in home ownership economically. And I think in his video, he was well intended, but he may have went off the rails a bit with this whole evil narrative, these evil, vicious, malicious banks. Listen, the banks aren't there to make money. They are there to make money. But in order for them to do that, they need profitable, stable borrowers to do it. Period. They need healthy banking customers, relationships. They cannot drain and milk their clientele and over the long haul and continue to make money. It's not a smart business model. It's not. It's just financial education. Most of us don't understand how to play that relationship. We'll go get a mortgage, jump into it, no clue how the amortization works, no clue how much interest we're paying, and no plan to make our home an asset or to use the value that builds up in that home over time. That's the problem. It's not the banks. That's not it. I wanted to give commentary on this video. I can rant on this all day long, but I wanted to give commentary on this video to help put context, because some of you may one day cross paths with my content and his content, and I wanted to complement each other. I think he does a great job, but I also want to catch some of my fellow YouTubers, financial content creators, at times when it's something that I personally have the knowledge base to speak up and clarify or give, clarity on. Because again, it's not about good and bad and evil. It's just about knowledge and knowing what you're doing. So I just wanted to compliment this video. I want to give you value in this video and understand banks need healthy customers. It's your job to educate yourself to make sure that you come out prosperous just like that bank does. Simple, nothing complicated about it. So thank you for tuning in. I appreciate your time. Please tune into his video. Take the time to tune in. I definitely drive some traffic to his channel because he deserves the shout out. It's great topics, and this is healthy debate. So tune into his video in the description, and then come back to this channel and catch up to more of my content as well to continue to level up and maximize your prosperity. To all my pioneers out there, as always, I want you to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.